You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. It was a choppy week for stocks. Investor cheer over the death of Osama bin Laden was short-lived. They quickly turned their attention back to corporate earnings and economic reports. Economic data that included a surprise jump in March factory orders, a decline in the ISM Services Index in March, a less than expected increase in private sector payrolls in April, but also an unexpected climb in weekly jobless claims. All of that leading up to the April employment report on Friday that showed the economy adding a more than expected 244,000 jobs, but with the unemployment rate creeping back up to 9%. And we'll talk more about that at the roundtable a little bit later on. Steve Reitmeister, you know what they say about May. Sell in May and go away. So do investors need to consider that as an option this May?
Well, it looks like they certainly considered it the first few days of the month. And, you know, they say if you're looking for trouble, quite often you'll find it. And there were some bad data points earlier in the week. When you consider GDP was soft last month, people had a little bit on the edge, you know, after that bad quarterly number. You had ISM non-manufacturing this week coming in the lowest level in 12, 18 months. Right. You had a jobless claims report on Thursday that spiked up to 479,000 or whatever, which is definitely the highest mark in quite a few months. So you had reasons to sell in May and go away. But this morning on Friday, the wake-up call was, hey, 244,000 jobs added, much higher than expected. This was the wake-up call that, hey, not all the data points are bad. In general, we do still have a recovery coming off a great earnings season, blah, 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 that I wouldn't necessarily sell in May and go away. I'm not doing that.
All right. Is the fundamental story then regarding the market losing strength? You probably say no, right?
Yeah, well, yeah. I was just laying out that there are more data points coming up that are a little suspect. But I'd still say the majority of the ones that matter are coming up good. And I just pointed out some of those out, but let me throw another one. One of the things that people was worried about was rising oil and food prices. Right. And what do we have this past week? We have a sell-off of some of the speculative froth that was in some of these commodities. Right. So if rising oil price is a tax on the economy and slows the growth, then isn't it coming down 10% right. Then a tax break on the economy and increases the odds.
Right. Tax cuts for everybody.
Right. and same for food and a lot of other natural resources. So I think that's a very positive event that just happened, and I still believe that the economic growth engine is still there. I'm not saying off the charts robust, but it is going to be 2 to 3%. Leading to higher earnings, leading to higher share prices.
Right. Okay, the person agreeing on the end is our market technician, Kevin Matris, who you may recognize. Let's talk a little bit about the choppiness, the volatility right. that we saw this week. How can investors best take advantage of the market if they're concerned about that volatility?
You know, I really do think one of the best ways to take advantage of the market is with options. I think more and more investors are using these in their trading, whether it be because of the volatility or in spite of the volatility. Plus, too, I think one of the reasons why they are being used so much is because options give you staying power. So that is just one of the things that will help you weather the volatility of the market. Plus, too, there's a whole array of different kinds of advantages. You don't need a lot of money to get started. It's a lot easier than you think, and you can pretty much make money almost no matter what the market is doing.
And what about flexibility?
Well, yeah, that is one of the key advantages. You know, you can make money if the stock goes up. You can make money if the stock goes down. You can make money if the stock goes sideways. You can even employ a strategy and make money if you are wrong about the direction of a stock. Now, of course, that doesn't mean that you can just blindly pick anything, but it does show the flexibility, and it does show that you have opportunities no matter what the market is doing and no matter what the condition is of the market. There is a way to be able to profit.
Okay, so making money is great. But how much money do you need to start? A lot?
Well, that's just it. You know, there's a good deal of leverage with options, so you do not need a lot of money. You can get into a position for a fraction of the cost of what it would normally take to actually get into the stock itself. And a lot of these different strategies actually give you a guaranteed limited risk. What's interesting is that with all of these advantages, most people still don't understand options, but they should. They are not as difficult as people believe they are. And all you really have to do is think about it. If you are bullish on a stock, you can buy a call option and make money as it goes up. If you are bearish on a stock, you can buy a put option and make money as the market goes down. If you believe something big is going to happen, either up or down, perfect for earnings season, you can do a straddle or a strangle. You can do all sorts of different things if you think the market is just going to sit there. You can't make money if a stock sits there in a stock, but you can make money in an option if your stock sits there. So with all of this flexibility, I think investors need to learn how to employ this stuff to supercharge their returns.
All right, we'll give you time to settle down because I know you get excited when you talk about this kind of stuff. We'll see you both back at the round table a little bit later on. Stick with us. There is more. Oh, yes, still ahead. Here is your Bull and Bear Stock of the Week. A farm machinery manufacturer and a retailer. This week's Bull and Bear of the Week. Shiraz Mian, our research director, back with us to fill us in on each of these. AGCO, A-G-C-O, the ticker is the Bull of the Week. That's the farm company.
That's right.
What makes them a bull?
The farm manufacturer, AGCO, is our play on the very positive outlook for the agricultural commodities market. Globally, all the major agricultural commodities, for a combination of supply and demand reasons, the prices are going up, the farmers are flush with cash, and typically that kind of environment outlook has been associated with farmers spending more on the type of equipment that AGCO and others are producing. AGCO particularly is very well placed because it's substantially international. It's about a fifth of its revenue comes from North America. Everything else is abroad. Europe is the biggest market for them. About half of their revenue comes from Europe. And Europe is coming off of a very low base this year and the next couple of years. And we saw that in their last quarterly earnings as well. Excellent balance sheet. The margin outlook is very good, and the key markets that they have in Europe and in Latin America are expected to drive top and bottom line growth over the coming quarters, and that's the primary reason for us having AGCO as a bull.
The company itself, AGCO, is also investing in its future growth. And so they're not just depending on the farmers' growth; they're going to invest in their own growth as well.
But they are. They have a pretty good lineup of products that they constantly come out with. But relative to their peers, they are more Europe-centric.
I see.
Their machinery is relatively smaller. Tractor is the biggest product. It's relatively smaller than, for example, what John Deere would produce to the market. Okay. So they have their own niche, and they are doing very good in that.
Talk to me about Kirkland's, K-A-I-R-K, rather, the ticker symbol. That is the bear. That surprised me a little bit.
This is a specialty retailer, yeah. More on the home decor end of the retail business. Now there are some macro issues that are weighing on that end of the retail sector itself. The misgivings, uncertainties on the economy's front, the continued softness in labor market issues, gasoline prices, and all the usual macro headwinds. And then there are some company-specific issues with Kirkland as well. They haven't done as good of a job with some of their merchandising mix as some of their peers have done. That's weighing on basically prompting and forcing them to discount some of that inventory. That's weighing on margins. Freight expense is increasing for them. That's weighing on margins too. And the overall competitive landscape for Kirkland has really heated up in the downturn. So a number of the discounters have moved into their product categories, and the regular competitors that they had in Pier 1 and Bath & Beyond, those are more aggressively competing with them on merchandise, on price, and that's affecting their product as well. And I see those pressure continuing.
Okay, we're talking about another stock next. And now, Stock Talk, analysis of stocks in the news. Well, Sony's been in the news a lot lately. At the beginning of the month, they announced that the personal information of about 77 million users of its PlayStation network had been compromised in an infiltration by an unknown hacker. Then, as if that weren't bad enough, the company said hackers may have stolen the personal information of yet another 24 million account users at its online entertainment division. So we asked our equity strategists Tracy Reinick and Mike Vodicka if this might have any impact on Sony stock, which is already under pressure. As of close of business on Wednesday of this week, stock is down just a little bit over 21% year to date. And they're here now with us to see if they can shed some light on all of this. So, Tracy, the obvious answer on the surface would be yes, but is that really the case?
Yeah, I mean, poor Sony. It was bad enough they had the earthquake and the tsunami. A lot of their manufacturing facilities were in the affected zone. And a couple weeks ago, they announced that 9 out of 10 of the manufacturing facilities that were shut down are now operating. But for a month, over a month, month and a half, you had major shutdowns. And then they're dealing with the components issue where that is being delayed. So they have that, and now they have the stuff you just talked about with the hacking.
Yeah.
I mean, these are major issues for any company to deal with one, but to deal with both, yeah, it's going to affect them.
And as of the time that we're taping this conversation, they have been subpoenaed to appear before the state of New York. Attorney General sent them a little note saying, hey, why don't you come on in and answer some questions? And we don't know where that's going to go yet. So, Mike, stock's under pressure. We've already established that. How long has it been under pressure?
Taking a look at the chart, I brought a couple of different intervals with me. But the first chart we'll look at is the 3-monther. But what you see is that Sony started to really run into problems off the Japanese earthquake. Share price started getting really weak in the middle of March, and that was directly after that happened. And since then, it's just been a general trend lower. The share price is definitely looking very weak right now. You can see on a longer-term basis over the last 2 years, this has been a very volatile name. It's been kind of a wild ride for the shareholders. Is there any support near term? The 2-year low is just below $26. We're at $28 right now, so the 2-year low is close at hand.
You know what I find interesting, Tracy, is that stock price is down as much as it is when the earnings growth this year has been good.
Yes, it's been much better. They took a loss of 44 cents a share last year, and they're supposed to make 92 cents this year. That's a big turnaround.
Yeah.
But the stock isn't real cheap. Even with this, the downturn that we've seen so far this year, it's still trading at like 21 times. So if the stock was really cheap, you might take a risk and say they're going to get over all of these things that are happening. But it's not real cheap, so there's not a lot of incentive for investors to go in right here.
Well, and then they've also announced that they're going to get into the tablet race soon, and they should be coming out with 2 tablet products here by, the fall, I guess.
Yeah, and that's not a bad market for them to be in because obviously they're known for their consumer products. They have a successful e-reader right now in the eNook, which they said they're going to put into at least one of these tablets that they're putting out. So yeah, but they're, as we know from some of the other companies chasing Apple, they're chasing them.
Right.
So they got to get into that area, but don't forget the LCDs are still their big market, and the TVs just aren't selling real well right here. So there's a lot of things that they're dealing with.
So, Mike, is this going to be a major headwind here for Sony as far as from a momentum perspective?
Well, we haven't seen the hacking issues hit the share price yet. It's more of a fundamental issue. So right now, not really.
Okay, we'll have to wait and see. Very interesting situation. We're coming back with the roundtable. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Jobs data and a choppy market. That's what's on the agenda this week here at the Roundtable with editor-at-large Steve Reitmeister, whom we met in the beginning of the program, Shiraz Mian, our research director, And that market technician, Kevin Matris, who also was at the beginning of the program. In fact, all you guys appeared earlier in the program. Yeah. So welcome back to our final segment here, where we're going to kick things around just a little bit. Steve, you already told us at the beginning of the show, headline number, adding 244,000 jobs in April was a good sign. So I'm going to keep that right there for the time being. And I want to start with Shiraz as far as the internals of the jobs report that came out on Friday. You know, they always say the devil's in the details.
That's right.
So what did you think about those internals?
I think very, very good. This is the best report that we have seen in a long time, and it's particularly good after the regular slew of reports that we got over the last week and the last couple of weeks, which was making all of us in the market really sit back and take note that the first quarter GDP slowdown may not really be the transitory slowdown that everybody was referring to, and I was personally very scared and concerned that we may see the estimates for the second quarter and the going forward coming down. So what this report does is that it makes us reevaluate those fears and concerns and makes us reassured that yes, the recovery is on track, and if the labor market sustains this growth momentum over the coming months, then it'll push us in the right direction.
Kevin, what do you think? You agree with that?
Kind of like hitting the reset button, if you will, after a week's worth of negativity and concern. Again, the 244,000 jobs that were created, that was fantastic. It was a 59,000 job increase. That is a 32% beat above the consensus. But the best part was that, you know, nobody's talking about it, but the government jobs fell by 24,000. That means private sector jobs were up 268,000. I think that's fantastic. He's talking about the internals, and I agree. You see job growth everywhere, even in the beleaguered construction industry. I think it was a very good report, and I think this will be the catalyst to finally get us to that 13.1 area.
What do you think, Steve? Is the economic growth on track as confirmed by this report?
Yeah, but here again, what is on track? I think some people were starting to get loftier ideas about what GDP, where it's going to become like out of this recession. We still have a lot of things that are weighing on us. The idea of 4% plus GDP growth, which is not uncommon coming out of recession, that's just not in the cards. Okay, but if we have 2 to 3% GDP growth on average, that is going in the right direction. It will keep bringing down the unemployment rate. It will keep earnings on the rise. It will make stocks an attractive place to be. But it's just a slower pace than a lot of people are used to. So I think this was definitely very helpful after a few bad data points the last week.
What about the market going forward, Shiraz? Getting up to summertime soon, and with the summer doldrums typically setting in, the choppiness, slight volume trade concern you? Is that a prelude to the doldrums?
I think the underlying driver still remains the same. This data point reassures us and helps us become relatively more positive about the outlook, but this is just one data point. Mm-hmm. The data points that Steve was referring to in the prior week and 2 weeks, we need to see a reversal on that front as well. Let's not forget that we got a 1.8% GDP growth rate in the first quarter, and we need, even if it's lower than trend, at least 2.5–3% GDP growth rate. And if the outlook for the second quarter and the coming quarters is in that ballpark, then I wouldn't really be concerned too much about choppiness in the market. I think earnings are very good, corporate profitability is very good, and we would be on the right track.
So where do you see the market going here near term?
Not doing much. I would expect the market to basically stall around where it is in the next 2 to 3 months till we get a clear evidence on where the underlying economy is headed.
Kevin, what about you from a technical standpoint?
I keep raising my outlook because of all of the good news that's coming in, but technically, yeah, I see 13.1 as being a target that should be hit, but honestly, I think that the market has the ability of getting even higher from a technical perspective.
Steve, market?
Yeah, I'm probably with, I'm kind of with both these guys. In the summer, I'm expecting volatility, and it's not because of sell and may and go away. It's because we are getting near relatively full value for the market, and we do need proof that the 1.8 was just a transitory soft spot. And so as we get towards the end of the summer, I think hopefully we'll have some of that, that news. So what I'm saying is 50% odds the market's higher a couple months from now, 50% odds it's going to be lower. But in my book, by the end of the year, 80+% odds the market will be higher than it is today.
All right, since we're here with you, tell us your top pick.
I'm going with Steel Dynamics. It's a very simple play on the growth of the economy. Steel manufacturers, they have great leverage as the economy continues to expand. They had a nice earnings beat, estimates going higher. I could easily see this company trading right now for around 18. I could easily see it in the 23 to 25 range.
All right, Shiraz.
Chipotle Mexican Grill. It's a good spicy pick. They have about 1,100 stores in the U.S. now. The long-term target is about 3,000. They have no international presence right now, so they have excellent comps, same-store sales growth rates. The margins are one of the best in the restaurant chain, and the long-term growth outlook, both here in the U.S. as well as internationally, looks excellent.
All right, Mr. Matris.
Same camp as Steve. Mine is Mueller Industries, ticker MLI. They are in the metal processing and fabrication industry. They supply product to a whole array of industries. They have operations U.S., Canada, Mexico, Great Britain, everywhere. The reason why I like them is they are one of the top industries, or excuse me, one of the top stocks in one of the top ranked industries. Double-digit growth rates, fantastic valuations. I think there is a $45 price target for a 20% gain, Steve.
Mine was better. Mine had a higher mine had higher upside.
You mentioned book a little bit ago. Kevin's got a new book out that we wanted everybody to know about. Finding #1 stocks, screening, backtesting, and time-proven strategies. Here is what the book looks like, if you can see it from that distance. You can find it on Amazon and some of your local bookstores as well. I want to congratulate you, sir.
Can I touch it?
You can autograph it for us here a little bit later on. Good luck with that. We appreciate you taking the time, all of you, and you as well, and hope the week ahead is profitable for you.